Hello and happy week 149. And what does week 149 mean? Well, it means it's been 149 weeks since March of 2020, and we all know what happened in March of 2020. I'm Ara Memorian. I am the founder of the Spring Team, a broker at Real Broker Ontario, and we're going to get into this week's market report. And today is, what's the date today? January the 10th, and it's 10 a.m. So all of these stats are relevant as of 10 a.m. on January the 10th, week 149, which is the week prior. And in this case, it happens to be January the 1st to January the 8th. And here we go. So a couple of things we're going to talk about in this video. We're going to talk about some communities that really had zero sales activity. It's the first time I have seen that happen. We're going to compare this week to this same week last year. And we're going to talk about some interest rate talk. As we know, the next hike is January the 25th in 15 days. At around this time, we'll know what's going to happen with interest rates going forward. But we do know that there will be an increase on January the 25th. I don't know why that's such a huge surprise to people. I've seen some creators out there, TikTok, Twitter, and all the various places talking about, yep, it's confirmed there's going to be an increase on the 25th of January. But we knew that because at the previous announcement, the government announced that they were going to continue quantitative tightening. And that's just the technical term for making it harder to get money and doing that by increasing interest rates. So it's no surprise, guys. Whenever there is an interest rate announcement, they tell you what they're going to do at the next announcement. I don't think I've ever seen it actually where they shift gears from saying they're going to continue tightening to not having an increase at the next announcement. When the federal government tells you they're going to continue tightening measures, that means that there's pretty much a guarantee that the next announcement is going to involve some sort of rate increase. Now, what could happen is that rate increase could be smaller than expected. That rate increase could be bigger than expected. That's really the only unknown here. So let's talk about that a little bit since I've already started to kind of go on about it. So let's say on January the 25th, there is that increase, which we know is coming. We just don't know how much. Some people say it's going to be 25 basis points, and 25 basis points is just a fancy way of saying 0.25%. The last time we had a 0.25% increase was the first increase, which was in March of 2022. So hopefully that happens again. But there's a lot of talk around using the strength of the December employment numbers, which showed an obscene amount of jobs being created, as strength in the economy, meaning we can handle a more aggressive increase. Some people think that that's what that's going to signal. But I would argue that it's probably a pretty terrible idea to use December employment figures, considering the seasonal employment that often happens in December. And if you look at historical December numbers, they're typically stronger than other months because of the increased demand from stores and other places that just have more going on during the month of December with, holiday shopping and etc. So I don't know if I'm missing something there. If I am, be kind and tell me in the comments. But generally, I really don't think that using December's numbers is a really strong indicator of how the economy is performing overall. Because if we're talking about jobs, look at the tech sector as an example. I mean, you've got Shopify, which is a massive company laying off all kinds of people, backing out of their commercial space that they had intended on taking at the Well here at Front and Spadina, which was going to be an epic workspace for that company. You've got a lot of other tech companies that are contracting right now, much like what happened in the early 2000s with the tech bubble bursting. And honestly, a lot of these tech companies deserve some of this pain. But I hate that their pain is causing the economy pain, because I don't understand some of these valuations, first of all, like that real estate company called Properly that had this ridiculous valuation and raised an obscene amount of money for what? And, a lot of these companies are grossly overvalued. So and they're overstaffed. And there's a lot of things that were extremely wasteful with these companies. So I guess it's one of those things that we kind of should have seen coming. But, when the economy is good, everybody's rolling and spending and earning and spending and raising money. And, this tech person is a genius and that tech person is a genius. But at the end of the day, there really wasn't any foundation to a lot of the hiring and money raising that was happening. And that's affecting our economy big time. And there are a lot of people that are homeowners that are in over their heads right now that are going to be losing their jobs. So that kind of leads me into the next topic right now is, looking at, I can shift over to the screen here for a moment. All right, so let's get back into it here. Now you can see the screen. Hopefully that pause wasn't too aggressive. So like I said earlier, we're going to talk about supply for a second. So I pulled up last year's numbers here. And if we just click on that for a moment, and see that we had 170 active listings at the time for houses and 626 active condo listings. I don't know why the internet is so slow here today, but it is what it is. So that is a pretty serious difference to what we are seeing today. And if we go back to this page right here, we're looking at 270, 100 more house listings and almost 600 more condo listings at 1,164 over here. So that is a huge discrepancy between this time last year and now. But last year was driven by the fact that there was really nothing out there to buy, so nobody was selling their houses, and it was kind of creating this vicious cycle of not creating enough supply for buyers. And whenever a property hit the market, it went for an obscene amount over the asking price almost 100% of the time. So we're talking about two different markets. But if you subtract we've talked about this before, if buyer sentiment was at a normal level today, these are aggressive seller's market territory numbers, as you can see here. Like months of inventory, to have under 1 month of inventory and to have under 2 months of inventory with condos a healthy market was somewhere between 2 and 3 months of inventory. So we're well within seller's market territory right here, except there are no buyers out there buying all these properties. And last week we had 3 communities. Where's my number there? Not 3 communities, but a whole bunch of communities within the 3 major communities, like the urban north, Leaside, Davisville, Yonge Eg, Rosedale, Deer Park, Forest Hill, Lawrence Park, all reported 0 sales in either houses or condos. Not both. I shouldn't say or both. It should say not both. Which is insane, because I've never seen an entire week go by without a single product type selling in any of these communities. And to only have 5 houses sell, 5 houses sold in 1 week, where last year this time there were over 20 houses selling, is not a great sign. I mean, but the thing is, with such few sales, we only had 6 new listings hit the market week over week. So if you look at last week's blog and compare it to this week's blog, there really isn't that pile on happening right now. But when is that pile on going to happen? I mean, it was supposed to happen by now. According to some real estate bears and some analysts out there, we were supposed to have a whole bunch of properties hit the market by now. So I really don't know if, it's most likely too early to call. And I say that right here, it's still too early to call because we haven't really seen the real jobs numbers come out yet in terms of, we haven't really, not the numbers come out, we haven't really seen the real effect of these job losses really show in the market yet. There's going to be a big lag between what happens now and then the result of people having to panic sell their house. I know one person who is in this position right now where they are completely underwater and neither of them are generating any income right now. And there's a very good chance they may need to sell their house. And these are people that were in the multiple 6 figures a year in terms of income as a dual income household. They have lost all earning power right now and are in a potential that might need in a position where they might need to sell. The good news is there's a ton of equity in their home. And that's the one thing people aren't really considering. If people are selling these homes, they are selling them with a lot of equity in their home. So they are able to come out on top at the end of the day. It just sucks to have to sell your house and then get back into the market down the road when you're when you've recovered. So anyway, there are people in this position right now, and it's not a good thing. And there will be some discomfort in the first part of 2023. I'm not going to put rainbows and unicorns all over that message. I mean, it is true that there will be an increase on January the 25th of 0.25%, 0.5%, whatever that is. And that's going to create some more pain in the market. And there are going to be even more buyers removed from the market at that time. But I do believe that sentiment will improve as we progress through 2023. It's just a matter of when. So if you're a seller right now, please take your property off the market. You should not be on the market unless you absolutely need to be for whatever reason. Your home will sell, but you're not going to get as much as you hoped for it. So looking back at the supply side of things, I'm really a huge fan of this program. It's called Habistat. It allows me to just kind of do some quick snapshots of what's going on in the market. And here's a great snapshot of what's happening in terms of sales. So this week, same time, just 1 week period last year, we had 301 total sales of houses in all of Toronto. Now, this isn't any of the specific communities I'm looking at because you're not able to drill down that deep in this particular program. I got to drill down that deep manually. And looking at this week, so 97 sales of all property types. And you can see such little activity in this higher price point. And remember, we talked about this a few weeks ago, that the majority of these price adjustments have happened in the higher price points that have affected the overall averages. So it's not like we have these $1.5 million houses selling for $900,000. That's really not the case at all. Some 1.5s from early 22 were selling in the 1.2s to 1.3s to 1.4s, but there isn't that dramatic a difference. But we have some, $3.2 million houses selling for 2.8. We've got some, $4 million houses selling for 3.6, that kind of stuff. There are those adjustments out there. But you can see here very clearly that there is a massive adjustment in terms of how properties are even selling, with 104%, almost 105% sale to list price ratio. Now you see most properties are selling under the asking price. And that's just also a really different, sales strategy, right? So it's not like there's a big adjustment in the sale price. It's just a big adjustment in how properties are listed. So previously during this week, you would have been a fool last year at this time to not put your property on the market below market value to attract those multiple offers to get to that big number you wanted to get to. That was the strategy to use then. That is not the strategy to use now. Now you are better to list at a price you're willing to accept and perhaps negotiate a little bit, which is exactly what's happening with this sale to list price ratio. So this is not really a stat that means anything. So I wouldn't focus too much attention on this stat. Just understand that these differences are a result of different sales strategies, not necessarily adjusting prices. And and then we have the average days on market, which has obviously gone up now from 19 to 28, and it's even higher in some specific communities. And also remember that because there is such little quality supply on the market today, a lot of people are buying sitting inventory who need to buy right now, which is obviously has a longer days on market. A lot of really attractive, turnkey, very well-built homes are still selling predictably and relatively quickly, but the majority of sales aren't those homes. In fact, like I said, there's only 5 in the entire downtown area, and none of those were south of Danforth, Bloor. Basically, south of Danforth, Bloor, from Etobicoke to Scarborough, not a single house sold last week, which is something I've never seen before. And you can see that the mix is relatively similar in terms of detached homes, semis, condos, whatever, but just slightly adjusted. So like I said, things are moving. It's just way slower than it was last year. So we're going to pay very close attention to supply over the coming months because it's going to tell us what's really happening in the marketplace right now. If we have stuff piling on, if listings start to pile on, we just do not have the sales activity to absorb any more listings that are coming to market than that are coming to market right now. So it's a very delicate balance right now. If people start coming to market, and this is why it's important for you not to be on the market just to test things out. If stuff starts piling on, there is going to be a problem for sellers. So right now it's not a problem, but this is not a time for you to test the market. If you don't need to sell, just put your feet up, chill, enjoy whatever you have to enjoy. Just do not go to market just to see if things work out. So January 25th is going to be an essential day for 2023, like we've said, in terms of the next interest rate hike and to see how people are going to feel going forward. But remember, it's not news. I mean, we've known this increase is coming for, since the last announcement. So again, we'll have these charts up later on. I'm just doing this a little bit early, so the entire blog is not ready yet. But my hope is that they're going to announce a halt to the hikes for the March announcement. But my true feeling is that there's going to be an announcement again, and that they're going to continue the tightening process into March. But I do really feel that March will be the last increase. Don't ask me why. I mean, it's just one of those things that I kind of feel we are reaching the end of this cycle. And I really don't see the banks continue or the government continuing to squeeze borrowers. The damage is done. The demand is gone. You're not going to all of a sudden have everybody come to market if you announce a halt. There probably will not be any decreasing of rates in 2023. And that kind of brings me to another point. I don't have a copy of this right now, and I don't really want to put it out there specifically, but there was a huge real estate brand that put out their 2023 forecast. I don't know why I air quoted that, but I just did. And honestly, they made some predictions about rates approaching the end of 2023 that I personally think are incredibly irresponsible. To tell a giant audience that you think that rates are going to be down like 2% by the end of 2023 is massively irresponsible. Nobody thinks that. Nobody who has a brain between their ears would ever say that. It just creates unnecessary, like, false optimism. Generally, it's really important to be optimistic. And if you've been following this blog and Real Estate Raccoons, you know that I'm an optimistic person. It only makes sense to be an optimist in the city of Toronto. Long term, we have a bright, bright future. But to mislead people into thinking there's some sort of chance that rates are going to come down as fast as they went up by the end of this year, that is misleading. So please don't pay much attention to those reports. Now I can properly use air quotes, because they do not help anybody at this point. So just know that 2023, as I've said a million times before, is going to be a very flat year, and prices should drop a little bit more this year. But does that mean you should wait to buy? Yeah, maybe for you, but if you're looking for something extremely specific and you come across that specific property, sure, it might be worth 20 grand less a couple months from now, but at the same time, that property is very specific. So it's not likely to come to market again. So you go ahead and make that purchase knowing that long-term you're going to be okay. If you're looking for just like a generic cookie cutter kind of place that's often available on the market, sure, wait it out a little bit longer and see what happens. But from what we've seen, despite all of these rate increases, we really have not had enough of a price adjustment for the majority of properties that we're talking about here to make waiting worthwhile. Waiting from January 2022 to now, prices are drastically different with some property types, but so are borrowing costs. So really, there's a great opportunity right now to get some decent deals on some assets, lock in a relatively short-term mortgage so you can do a refinance in like 18 months or 24 months or 36 months and take advantage of those lower rates that are inevitably on the horizon. But the most important thing is for you to be able to take advantage of the low prices today. And why is that important? Being able to take advantage of lower prices today, regardless of the borrowing costs, will allow you to take advantage of the equity that you'll immediately gain once buyers start to come back to the market as interest rates come down. As the value of that property increases over the next few years as rates come down, you will be able to draw on that equity to make other investments and do all kinds of things. This is what it means to have real estate work for you. Real estate is really not working for many people right now unless you're a landlord with multiple units that you're collecting tremendous amounts of rent on right now. But there are even a lot of landlords that are really in break even or negative cash flow positions because of the rates the way they are today. But don't get it twisted. If you get a great deal on a property today, it will be worth more a couple of years from now, looking far out, maybe as far as 5 years from now, and you will be able to take advantage of that equity to do all kinds of things down the road. We're not talking about over leveraging yourself, so calm down, haters or whoever it is that's paying attention to this. We're not talking about over leveraging. We're talking about making smart financial decisions. We're not talking about using your house as a tax-free ATM, although that's technically what it is. We're talking about making responsible financial decisions, leveraging the assets that you have. And technically, we're not really supposed to be treating our principal residence as an investment. However, you can temporarily, as long as you're not over leveraging yourself. So anyway, I think we've gone on long enough for today. Generally, there is going to be a lot of headlines that are going to create a lot of anxiety in the market over the coming months. 2023 is going to suck from that perspective because there's going to be a lot of anxiety, and the real estate professional's job is to reduce that anxiety. Our job is to take what we read out there and put it into context for our clients. It's not to feed into that. You are not considered a truth teller because you feed in to negative news. I consider myself a truth teller because I like to read between the lines and help people understand that there is more to the story than what's happening this week. Remember, we're not day trading real estate. A real estate raccoon jumps into the market whenever they can, takes advantage of opportunities whenever they can, and then reaps the rewards down the road. Buy now when nobody else is buying, and sit back and watch your investment grow down the road. But buy smartly. Give me a call. We'll talk soon. Thanks, everybody. See you in week 150. That's next week. See ya.